Okay, folks. I'm David Russell, VP of Market Intelligence here at TradeStation, and welcome to the Art of TradeStation, option strategy for earnings season. We go into earnings season. It's always an interesting time to consider things like options to manage risk and kind of, manage certain things around positions, whether you want to be entering or managing existing things. So before we get started, I want to just share very quickly a series of links with you. These links here that I just gave you in the chat include the zip file that we're going to be using. Let me actually show you what that looks like. Excuse me. That's what the zip file looks like. And in here, we actually have a workspace I'm going to be giving you and the slides that I'm going to be going through. It also, this has the links to the different things that are in the disclosures I'm going to show you here. Just some important information about things involving options if you want to quickly take a look at some of these disclosures. So you want to go ahead and open up that zip file. We'll get to that first. All right, now remember, all these links are available in the chat, and they're also available in the PDF. So if you go to the first link, the zip file, this is what you're going to see. You're going to see a PDF. Let me try to make this. Sorry about this strange thing popping up. All right. So you're going to see this is a PDF. This is the workspace, and this is the ELD file that contains certain indicators. You want to load the ELD first, and it's going to bring up a dialog like this, and it will bring in a series of indicators that will then work with these with this workspace. So you would basically double click it like this. You would say next. It lists these. I'm not going to do that because I already have them, so I'm just going to cancel it. And this is what you'll see. And then when you have that done, you can double click on this workspace, and this is what you're going to see. Okay, so most people know this, but I want to just very quickly zip over well, actually, before I do this, I want to just very quickly take a look at the market, where it stands right here, and just look at, it's interesting to see some of the data we had today, because we saw today the purchasing, the PPI cool more than expected. We saw weak retail sales. We've seen a lot of evidence here of inflation coming under control and some worries about the economy. So it's interesting because in many ways it's exactly what the Federal Reserve wanted to see. And it's really interesting because the overall market is pushing against the 200-day moving average and some falling trend lines. And it's an interesting sort of moment we're at right now. I wanted to just kind of quickly point that out to a certain extent. If you go to, I want to just show you something very quickly. This is something I did quickly on TradingView, but there's a weekly chart of the S&P. And if you look at the long term, there's been a price channel going back for, better part of like 10 years here. And then this is the downtrend line this year. So what's interesting is we're squeezing between these two levels. This shows that there was a 50% retracement of the rally off the October low. So it's interesting just to kind of see us watch and push against these levels. Another thing is that if you go to TradeStation.com and you go to the Market Insights blog, which if you just go to like TradeStation, right, and then you go to Research and Insights, I did this blog post recently, and it kind of shows that in some ways, this market right now is kind of the opposite of last year. Last year started with a lot of sort of deteriorating breadth, and it was pushing against a rising trend line, and it failed. And this year is kind of the opposite. So it's an interesting kind of like inversion of one year to the next. So I wanted to just kind of point that out. But the other thing I wanted to just mention was that we continue to see declines in the 2-year Treasury yield. So at this point in time, there has been a certain sense that, we're getting near the point when the Fed might want to pause. Of course, we have a meeting on February 1st, and we have a lot of uncertainty with earnings and everything else. But this is a pretty interesting area where the market is right now after today's economic news. So it's interesting to think about things like earnings season coming up in terms of how will companies react to their news, and that's something we're going to cover right now. So I want to just quickly kind of show you that there are some interesting sort of techniques that I'm going to show to kind of identify direction in terms of looking at using different strategies. But first one, just quickly mention, calls. Call options fix the price where a stock can be purchased. They gain value when stock prices rise. They have a positive delta, and they can be sold against stock or against calls. So when you look at options, they're going to have delta, which says how much the option moves relative to the underlying price. And then calls have positive delta, which means if they have a delta of 50 and the stock goes up $1, the calls will increase by 50 cents. It's a quick way to know how much of a difference you're going to get. The next thing are puts. Put options fix the price where you can sell a stock. They gain value when prices fall. They have a negative delta, which means if the price goes down of the stock, then the price of the puts go up, and they can be sold against other puts. So calls can be sold against stock or against other calls, and puts can be sold against other puts, which is important because it's some of the things we're going to look at. So there's a thing called vertical spreads, and that's when a person is going to buy a call near the money and sell a call farther away from the money. So let's now go to our this right here. I was on slide number 8, and I'm going to go here to our chart, and I'm going to open up TradeStation Pro. So for example, if a person, I'm going to start off right off the bat with Netflix as my first example. And the reason why is because this workspace shows that Netflix reports earnings tomorrow afternoon. So there's an interesting sort of example. So for example, if a person was bullish and believed Netflix was going to have a good earnings report, they could look here and essentially see a price range of like 335 up to like 340 or 345. That's a potential vertical call spread. So if a person wanted to be long on this, what the call spread would do is they would buy the call that's near the money, sell the call that's away from the money, and they'll capture or move between those two prices. The thing about this is vertical spreads can generate leverage and help manage risk. They can be useful during earnings season for both positioning and for hedging positions, which means if you want to simply be long on something like Netflix and it can have a good earnings report, something like a vertical spread can do that. If you want to do the same thing to the downside, the thing is, if you go off and buy shares of Netflix, you buy 100 shares or something, you're talking $32,000, and there's all kinds of downside risk on something like that. So let's look at the TradeStation Pro. So we go to our apps, and then we go to TradeStation Pro. It looks like a little paper airplane. Bring this up. All right. Now yours might not look like this because I've customized the columns. If you go to this little wrench up here, you can see how you customize columns. And what I've done is I've included simply extrinsic value, intrinsic value, and delta. Okay, so I have this set right now to vertical spreads. If a person wants to do simple calls, what they can do is they can just go to single. In this case, I want to show you the vertical. So you can set it to vertical, and then you can look at something like this with a name like Netflix. So if a person, for example, wanted to be bullish on something like Netflix, if you were to click on something here, like say, for example, we want to target a move above something like 335, a person could do that with this call spread by clicking on this. And that's going to basically, for the cost of about $1.95, if the stock goes up to 340, that spread will be worth $5, which is more than twice what the person would have paid for it. So this is a quick example of how this sort of thing works. So let's go back now to the presentation. We're going on to slide 9. Okay. So here's an important thing to understand about call spreads. As you look at this, with vertical spreads, it's true for put spreads as well. You don't want to be in a position when you are closing it before expiration. And the reason is, if you look at this spread right now, here I'm going to first show you, we go back to single. Well, actually, if you look at here as a spread value, you can see that a call spread that is right now kind of in the money. Netflix is right now around 325. So a call spread like this one is completely in the money. But right now, if a person had bought that when the stock was lower and they look to sell it now, they wouldn't get the full $5. And the reason is because the different options, if we now go to single, you can see that these options have a huge amount of value in them. The intrinsic value of these is quite low, but there's a lot of time value because you have all the event risk. So what does that mean? It means that with call spreads or put spreads, either one, you don't want to be closing it in the, just by trading it. You want it to go through that level and then expire there, and then you basically collect the full $5. And the reason for doing that, or whatever the spread is, and the reason is because you're going to have a lot of bid-ask spreads on both sides of it, and it can be difficult to get the full value. The other thing is it might jump to a level, move around, and you never capture that full amount. So one of the things I want to emphasize in this webinar was some of the ways to identify opportunities that will not have that kind of frustration. So you may not reach their full value until expiration. Therefore, traders may prefer setups with the potential for both legs expiring in the money. Okay, so that was slide 9. Now, vertical spreads are mostly suited for big moves. So we might want to look for things when you have favorable price trends and levels that look relatively clear for potential breakouts. And that is the reason why right now I'm looking at something like Netflix, because if we look at a name like Netflix, there are some levels here that we can see right around 335. That was the top, where it held right before it gapped lower back here in April. So if people are looking for something bullish, this is a sort of thing where if it pushes up above 335, there could be a potential for an extension. And if this stock does have a bullish move, this is a sort of potential setup. When you look at the historical examples, that could likely move up past the $5 or the $10 level you're going to look at. So if a person was inducing like the 335 to 340, a stock like this, if it's going to be bullish, we're not saying it is. It could be, if it has a bad news, then that won't move in that direction. But if it is going to be, a stock like this has the potential to move, much more than just up to 345 or 350. It could push up more. And I'm going to show you the reasons why. So I include these in two potential categories. For our bullish sort of setups, I call this kind of breakout and run. And we're now on slide 11. So there's several different examples of these. We're looking for three things. We are looking for a clear resistance area to break, like I just showed on Netflix. We're looking for space for expansion to the upside. And we're looking for something that is flat or positive in the last month. When things are trending sharply downward, you can get a rally and then it might fade and you're not going to get that extension that you want for it to expire in the money. So let's look at some historical examples. You can look at this at your slides here, slide 11, and I'm going to show you some examples here. All right, so look at Amazon back in July. Amazon back in July, it was trending upward. It was roughly high. Had been trending higher for the previous month, and you had a clear level around 125. When it broke through that, it moved up for several days. And if a person had done the 125, 130 call spread, this would have extended and it would have expired in the money, and they would have, made a significant, return on that. Now, the other thing I'm introducing here is MACD. This chart has MACD on it. So what we're seeing here is we're seeing that the stock was trending higher and MACD was positive. I have found that MACD can be incredibly useful for this use. And that's one of the key things we're showing on this chart. MACD means moving average convergence divergence. Is a popular oscillator that shows momentum. So the thing is that in many ways, the main message of this method that I'm showing is that the option strategy should be pointing in the same direction as MACD. If you have a stock with falling MACD, you can have the risk of the strategy, even if it moves the right way. Like if you have a bullish rally, falling MACD, it might not work. So that's Amazon. Let's look at Microsoft. I'm going to show you an example of when it doesn't work because MACD was not with you. So if you look back in July at Microsoft, you had a pretty clear level here. This high around 266, or even this level here around 270. Once it blew through that number, it had rising MACD. It was essentially flat to up in the previous month, and we had a clear level, and a person who would have targeted something like the 266, 270, like 3, or something like the 270 would have gotten that to expire in the money. So that's the next example I want to show you. Now look at Netflix when it broke out in this level here. Okay, a similar situation. MACD was not exactly rising, but you had a very clear level, and you had essentially a move higher. This one's not quite as clear, but you had something when it was essentially in the kind of in the intermediate term moving higher, and this was one where it also had a relatively clear level. Now the opposite, let's look at Meta back on April 28th. This one had a bullish earnings report, but you'll notice that MACD was falling. So this stock basically just sat and chopped here, and it continued higher a little. But if you look at this, there was no clear level for it to break. If you look at, like I said, something like Amazon here, this one had a clear level right around this kind of 125 level. So Meta is an example of a case when the vertical spread is not necessarily the right sort of setup. And the key point is that the MACD can be a big indicator. Now look at some of the more interesting recent ones. Morgan Stanley, for example, had rising MACD, had a good earnings report, I think it was last week. And if you look at this, you can see how it just extended up. Now, a person who could have targeted something like I'd say around, I'm not even sure which level on this, maybe around 93 would have been the level. But the key thing is the MACD was rising. Now look at Goldman. Goldman had a bad earnings report, but the MACD was rising. So the thing is, there's very little follow through to the downside on this. So this just kind of shows that MACD, having the MACD going in the direction of the spread, can tilt the odds more in your favor if you want to take a directional sort of position on earnings. Another good example was Oracle. There's one that would not have worked because of MACD. MACD was falling. The stock had a strong earnings report, and look what happened. And I can tell you, I've seen this pattern many times when you have a good earnings report and falling MACD, and it gaps up and it just gets crushed. And that's exactly what would have happened in a case like this. A person looking for a vertical spread would have gotten hammered lower, and you say, why didn't that work? Then you look down at MACD and you see it was falling. So I wanted to just point this out. That's another example. Another one actually was IBM back in October. MACD had started higher. It had an interesting level here around 126. And so you had the combination of rising MACD and the level. Those are the two things I wanted to really point out about this technique. Now, I call that breakdown and run. The next one I call crash and burn. So let's look at something like Meta back on, October 27th. There we had, MACD was, you could say it was rising a little bit. The trend was lower, and the other thing was it was going lower in the previous month. So the trend was lower, and then it had a very clear level right around here between like kind of 125 and 124. And when it broke through it, it was just a very sustained and clear move. A person targeting the downside with a put spread could have actually had a pretty clear sort of level, and it would have expired in the money. And again, that's the key thing. Remember, we're looking for stuff that's going to expire in the money, so we don't have to worry about closing it and having the trouble with bid-ask spreads. Another example would have been Snap in July. Well, actually, this one did not have the MACD going in the direction, but what's interesting is it did have just a clear level that could have been targeted under this low. So the one that was interesting to me that was kind of jumping out now that I wanted to mention was Altria. This one has been struggling, and a person might be looking for this level around 43. And I wanted to just kind of point that out because this is one that was popping up just based on the analysis I was doing today. So let's look at this workspace I've shared with you guys. What does this have on it? This has a study that I've shown you guys before called earnings date studies, next earnings date. All of you should have this on TradeStation. So what this allows us to do is this allows us to basically plan for earnings season by looking at when companies are going to be reporting earnings. So we can see basically a calendar of all the things coming up. Now, another thing I've done is I've provided a special indicator called MACD diff. And what this is this is just the histogram portion of MACD. If it's positive, like MicroStrategy, for example, it means MACD is rising. If it's negative, it means MACD is falling. So this allows you to quickly see, okay, here's a company that reports earnings in 6 days, and MACD is starting to move lower, for example. Here's a company that reports earnings in 13 days, and MACD is rising. So, for example, the approach would be like as you're 2 to 3 days away, or right before, you can see the stuff that's going to be reporting soon, and then you can basically see the direction. Now, the other thing I want to point out is that this has another indicator called 21D, and this is just a trailing 1 month change. And this is going to give you a similar sort of signal as something like MACD. Essentially, it's going to show you the direction. When something is down a lot in the previous month, like for example, something like this here in Tesla, this is when MACD doesn't always give you good signals. MACD, when something is trending lower, MACD will turn higher and then just peter out. So the combination of MACD and something like the trailing 1 month return can kind of help you identify those trends. And based on what I said, the thing that popped up that kind of caught my attention right now would have been something immediately off the bat. The ones that are jumping out to me would be Netflix. And then if you look down here, what else do we have in terms of time to reporting? MO is on the list, but that's still a little ways off. So like a lot of these, this is still like 3 weeks out. So don't forget, things do get a lot more interesting and active next week. And that's really what this is. That's why I'm doing the webinar today. Okay. As we see this filling up. Now I'm going to tell you a little bit about this list in a minute. First, I want to make sure I cover my presentation. All right, just a few things to think about. These are things that I have noticed myself because I write about the market a lot, doing the Market Insights blog and a lot of other stuff, is that not all sectors report equally to earnings. Very often you'll just get something like, technology stocks, they have good earnings. That's usually going to jump based on the earnings or drop on bad earnings, like we saw with Meta and stuff like that. Often with retail stocks and industrial stocks, they will move based on their earnings. Now, the problem is that some sectors do not move based on their earnings. For example, energy stocks, you might have good earnings and oil goes down and ExxonMobil goes down. So I think it's important to realize that this sort of strategy of looking for earnings-based moves works differently based on the kind of sector. It's more suited to things, especially kind of like technology, retail, and financials are kind of ambiguous. These financials like Goldman and Morgan Stanley moved according to their news recently, but very often financials don't. They can do a lot of tricky stuff. They drop on good earnings and a week later they start rallying. So those are kind of tricky for the kind of directional trade. All right, so another thing important about options is that when stocks don't trade a lot of options, they are not as liquid. So what that means, if we go back to our OptionStation Pro, we look at just single calls and puts. We look here, this stock is at 326 right now. So these are kind of at the money. So basically, if you were to buy, you'd have to pay $17, but if you sold, you get 16 and 3/4. So this bid-ask spread, for a stock, it's not that wide, but with options, this can cost you a lot of money. So the more liquid a stock is as an underlier, the more options it trades, typically the tighter the bid-ask spreads are going to be on it. And when you get a more obscure stock, I don't think of something like, Chubb, which is this totally obscure insurance stock. I mean, a company like this, the bid-ask spreads are, not very, they're pretty wide. There's not a lot of volume in them. But then you go to something like Apple, and you get a lot of, you get tight bid-ask spreads. So the basic thing is it can be a good idea to look for companies that trade a lot of volume. And there's kind of two ways to do that. So I gave you a list here of stocks that trade a lot of options. And how did I do that? So I go to, let me just make sure I have this slide here. You go to the scanner, and there's two ways to do it. First of all, with scanner, you go to apps, and then you go to the flashlight. And you can go to create a scan, and I'm going to just call it something like top underliers. And now I'm going to go to all stocks. Now mine by default has these other values. I'm going to just remove these. And then I'm going to go to indicator. And this is one you guys all have. You go to volume, all options, okay. And then this is going to have two outputs. We're going to go to volume average, and we're going to go to greater than 25, 1, 2, 3, and we're going to run. Now this is going to take a little bit of time to run. So what I already did was I took the output that I already had and I put it into this radar screen for you guys. Now you're going to notice that there's another indicator here. It's my own custom indicator called average option volume. And this essentially does the same thing as the indicator I just used here in Scanner. But the difference is that it will highlight stocks that trade a certain threshold. And I've shown this to you guys before. In this case, I have it set to show me 21 days of volume, and then show me highlight if it trades at least 25,000. In this case, it's set to 10,000. So let's change it to 25. Okay, hit okay. Now, these are all above 25,000. And this is also a kind of a random list of stocks. You have random companies on here like Chewy. You have stocks like BlackBerry. I mean, you almost forget that exists. Anyway, these came up because they trade a lot of options. I took these from Scanner. But say you want to stick with a big index like the S&P 500 or the NASDAQ. You can just go down here, go to data, add symbol list, S&P 500. And now it's going to import the entire S&P 500. And what it's going to do is it's going to highlight those companies that trade at least, in this case, 25,000 contracts a day. If you have your own list of stocks, you can dump them in and out and quickly see them. And then all the functionality I already showed you of sorting by days to earnings, MACD, things like that, all that functionality will be available to you. So I wanted to show that we can basically use Scanner to find a lot of this stuff, or we can use Radar Screen. These are two awesome tools that we have on the platform. And just so you realize, this is a custom indicator that I gave you guys, along with like that MACD difference. You have to make sure the ELD is loaded for it to work. All right, so very quickly, I'm going to show you just how a person would do this. For example, this Netflix, and in this case, let's go back and take a look at the chart again, Netflix. All right, so let's say, for example, based on this kind of logic that I was showing you, say, for example, we believe Netflix is going to have a good earnings report. I'm not saying this is not a recommendation, but if you're bullish on Netflix, like I said, a person could buy the shares, and if it's wrong, you could easily see a stock like this gap down to 280, and that can be a painful, drop if you're long equity. So it's something like the calls, like for example, as purely for educational and not as a recommendation. Say we want to say, if this stock is bullish, it could maybe extend up. And see here, we have a potential space. So we could look for something like a move from say 340 to 345. So a person now would go to, you'll notice this is set to single. We want to set it back to spread. Wait a second, vertical, I'm sorry. And then we can look for something like 340 to 345. You would click on the ask. Now you can set a limit order. That, for example, right now the ask on this is like 210. You might be able to put in a limit order for like $1.90, and the stock will drift around and it could get filled. But just for the sake of demonstration, I'm going to set it to market order, and I'm just going to go place order. And if you look what comes up, now I have it set to 5 contracts. So that's basically the overall value. And something like this with 5 contracts, this could have, this basically breaks down your overall potential profit on a trade like this. It shows it all right there to you. I'm just going to hit yes, and it's going to say, wait. Oh, wait a second. Something happened here. I think my TradeStation connection turned off. Let me log back in. This is a simulated account, just so you realize. Here we go. All right, go back over here. This sometimes happens when you run a lot of queries. I was overtaxing it a little running Scanner, I think. So I can just go place order, shows essentially the potential risk reward on something like this. It has the potential to make about twice of the actual cost is. You can hit yes, and it would have gone through and showed as a filled order. Now, I have another hypothetical position in American Airlines. But before I do that, let me just show you. All right, I want to first explain covered calls. All right, so that's the idea of something like vertical spreads. And like I said, the idea is the level, you're near a level that has that potential for a breakout and expansion, and you have some short-term momentum or direction in your favor. The difficult thing is betting against something like falling MACD. Even if you get an early pop, it might not have very much staying power, and that can be frustrating because without the staying power, it might not close in the money, and then the whole point of doing a vertical is out the window. So a name like American Airlines, this reports earnings on the 26th. They pre-announced some good numbers, and say a person is long this and you're sitting on some profits. So investors owning stocks can sell covered calls against their position. Covered calls are in premium and limit upside. So basically, say for example, a person owned this stock, like AAL. Let's jump over here to AAL. You can see here that it shows me owning 500 shares. Now, this is all just hypothetical. I just entered this today. So imagine I had, bought it when it was a lot lower and I'm sitting on a big profit. Now, a person could say, for example, you think the stock is going to just stay essentially where it is. In that case, a person could target selling something like at the money call. So we see right here that the earnings are due on the 26th. So we can very quickly go back here to the options button right there. And we're going to target the expiration week, which is here, the 27th of January, because they report on the 26th. And we're going to change this now to single. And say, well, actually, let me just go through the actual order I have it here. If you believe the stock is peaked and it's going to crash, then you can look to sell calls that are essentially in the money, which means that there's less risk because what it does is it chops the top of the price off. So if a person, for example, we look at the stock price again, it's around 17. Say you think it's going to knife lower to like, under 15 or something. A person could do something like sell the $14 calls, and you could just click on the bid, and you could simply sell them. And and in this case, now remember, I have 500 shares hypothetically. I could just go over here to market, and then I could go to place order, right? And then I'm going to go to yes. Now the thing is if you don't own the stock, then you cannot sell calls. That's highly risky, and a lot of people, if you don't have the actual position set up, if you don't have your level, to the trade, and you can't even do it anyway. So I know if I now go over here to manage, you're going to see that I have these two together. I have the shares and I have the calls. And what I can do is I can click on them, and I can then actually go to merge common legs. Before I do that, first I want you to see that if I own 500 shares, I have 500 long delta. I sold calls that had a lot of delta. So I've actually reduced my delta now to essentially like the equivalent of only owning about 20 shares. So remember, this was the one that is most bearish. I'm basically saying, I'm afraid of downside, so I'm going to sell in the money. So what I did was I just turned my 500 shares into 22 shares. And this is an example of how that works with net delta. So by using delta, you understand right off the bat what your actual positioning is. To very quickly show also, if a person here thought the stock is just going to kind of sit where it is, they could then go to options, and this is the stock around $16. If you were to sell calls right around this level, what would happen is, say the stock closes right around where it is, the person would collect the time value, which is the extrinsic value, around 56 cents per share. And then the options just go worthless, and you collect that money, you keep the stock, and you're essentially kind of neutral. If you're really bullish and you think the stock can jump up a lot, you could do something like sell the $20 calls or the $19 calls. In this case, you don't get very much premium, but by selling those calls farther out of the money, you'll also notice they have less delta. So when you sell them, you have a negative delta on the calls you sell. Calls have long delta. When you sell them, you have a negative. So this is basically, instead of subtracting, in this case, we were subtracting 94 delta. In this case, we're only going to be subtracting 10. So our net delta would be much higher, which means that we're more sensitive to movements in the stock. If American Airlines rallies, we have more participation to the upside. If it drops, we lose more to the downside. So that is an example of how a person can use options around earnings season. So these are two different things. One is looking at something like Netflix with a vertical spread, but looking on for a rally on earnings, a move based on earnings. The other thing is where we own a stock and we want to protect ourselves because of a potential drop. And we're using the covered call to do that. So those are two different things. One is we're entering earnings season or entering the event with a position. The other one is we're looking to position for a move. So one is directional and one is essentially hedging. But in both cases, we're using similar principles. And in both cases, when you look at the the levels, it can help you a lot. And it's a really simple kind of way to think about it, which is that the more delta you're selling, the less bullish you are. And it's simply a question of, do you want to cut the whole? If you sell like 14, you're essentially cutting off all this. And as long as it stays above 14, your position is essentially flat. If you sell, the higher up you sell the calls, they're going to have less delta, which means that you're going to have more risk. But it also means if you get good news, you have more potential for a rally. If you sell these calls like the 14 and American Airlines goes to 20, you get nothing on that because those calls you sold that you're short will gain value with the stock and you just lost everything. We don't lose everything. You lose all the upside above that level where you sold the calls. So it's important just to think according to net delta. Now, the last thing I want to show is the idea of protective put spreads. We did mention the idea of using using puts to the downside on something like the example of MO, Philip Morris or Altria. The only one that really popped up for me. But it's the same sort of thing. If a person is long AAL, they can do something like buy a downside put spread. So we go back over now to AAL and we're going to go to spread. Go to vertical. I'm sorry, it's called vertical on this. A person could do something. In this case, we want to target the we're looking at the correct, always make sure you're looking at the correct week. We're looking at earnings week. And a person, for example, could do something like the stock around 16.5. A person could, for example, buy this put spread, which costs about 34 cents. And if the stock goes down to 15.5, that put spread then goes worth $1. And it's essentially about a 200% return. And that would essentially give you protection. About 70 cents of, you would be paying 34 cents, and then you'd be having about 65 cents of protection. So a person can use a vertical spread. In this case, we were looking at 16.5, 15.5, and that would be a level right around here down to right about there. So I wanted to just kind of show you. I mean, this would be even a level you could target. You might want a high like this. You might think it has a bad number. It's going to pull back toward this level. But that's just some of the ways a person can use, puts, even if you're long stock from a protective position. Okay. The other thing that's important is that unlike covered calls, put spreads do not reduce upside potential. So for example, with American Airlines, you might pay 35 cents for downside protection, but if the stock goes to 20, you make all that money and you just lose the 34 cents. So that's the kind of risk reward. Covered calls pay you, but then they have limits on what they give you. Put spreads cost you money. They're a debit trade, which means you have to pay money, but then you also get the benefits of paying money, which means that you still have that upside potential. So it's just something to kind of think about and understand the cost benefit of each situation. Options can go either way. It's just good to kind of know that you can hedge with covered calls and you can hedge with put spreads. And I'd also just say that in many ways, hedging is about managing risk. And even if you're taking a vertical, a long position, like say you are bullish on Netflix or some other stock, you're still managing risk because the amount of money that was at risk, it was something like $2, is significantly less than the amount of money you'd be risking by owning the shares. So it's always about managing risk and being able to participate in moves with less capital at risk. And that's really the point of why we want to look at options. Okay, so just quickly, aside from serving as a bearish directional strategies, put spreads can also provide hedges on existing long positions. Investors can simply target downside strikes as protection. This allows you to hold through the risky earnings event. Okay. So, like I had said, there is this study that we've talked about in previous webinars called Next Earnings Date, RS. And then I already explained this idea of scanning for stocks that have 25,000 contracts. You can then copy and paste that from Scanner into Radar Screen. Let's go back over here and actually just quickly look at our scanner. Top underliers. Wait a second. You know what? This is the thing that kind of crashed my my price server. I think I had too many things going at once. So I'm going to just leave this alone for now. But if you look at the way I did it, basically what it was, the scan criteria was I just had volume, all options, and then the volume average greater than 25,000. Okay. So just very quickly want to go over the last parts of this workspace. What this does, again, this includes a few different things that I want to just quickly show you so you know the things about it that are unique. It has the next earnings date RS indicator, which allows you to sort by days. It tells you when the dates are confirmed or not. And then it allows you to see the things with rising and falling MACD. This list at the top was the one I gave you that was based on the active underliers. But if you scroll down here, you can actually see where we got down to the S&P 500, which I added. It's here somewhere. Here. This is where I added the S&P 500 index. You can see there's a lot of S&P stocks like Mettler Toledo, which is some random, medical device company. It doesn't trade any options. These are not stocks that people trade actively, but you can quickly look at the big names in the S&P. Of course, you have Apple and Tesla right there at the top of the list. So this allows you to single those things out. You can hone in on direction. You can hone in on when the results are, and you can hone in on the active underliers. Over here on the price chart, I have MACD, which just so you know, I made the lines thicker to help you kind of see. And I also have here the next earnings date function, which is the chart version of this. And what I did was I clicked on it and I go to edit text, and then I changed the object. And I basically, if you go to the inputs, I moved the present from right to 70. So if you do this yourself, it's going to be over here in the top left. And I just wanted it kind of more in the middle of the chart because I found that it would overlap with the price chart less. The other thing is I changed it to white. That way it stands out more in contrast. I use black charts. If you use white charts or whatever, this is how you'd actually customize it. Also, what it does is it has a threshold. If earnings are close, like for example, Netflix, it will highlight it with orange red. You can customize that as well. So if you go to something again like Netflix, you'll notice that it's orange red because that is the threshold. So that's essentially how these things work. The other thing this has is EPS postings, and EPS postings they show where the earnings reports were. And I also changed that. I went to I changed that so everything just shows up as white, and it stands out better on my black chart. All right, so let me see if I have any questions. Let me know if you have any questions before I go. I wasn't going to have the S&P, was trying to hold around 39.50. Here's another thing I'm working on that shows price channels, but there were some levels here from last week around 39.50. It was trying to hold, and it is not. So this is just the cash index I was looking at. And, we're just in this very tight range here. And I'm not really sure exactly, what to make of the sort of price action at this point in time. There's just a lot of everything coming together very tight, and there's arguments on both sides. And triangles, the one thing I'll say is, remember I showed you before, there was a triangle on the S&P between the weekly falling line and the longer term uptrend. And the fact is that triangles are one of the most frustrating things for all traders. And so I think it's important to realize that we are in something of a triangle behavior here on the index. And that is something just to be careful of. So those are the main things I wanted to show. So I thank everyone for joining. And I am also going to be starting a weekly webinar I'm going to be starting a weekly webinar at the beginning of February called Market Trends. It's going to be every day at 2 p.m., every Thursday at 2 p.m. starting in February. So look forward to seeing some of you guys on that. Take care, and I'll see you soon.